All right. What are we doing today? L.
L is for losses, and Lauren.
And Lauren. Yeah. So last week the other week it was Jade.
Joe.
Jade, Joel.
All of the J's.
Everyone's got a J name. So L is for losses. So we were trying to talk about it, and when I said, what are we going to talk about? There's actually quite a lot to talk about. So first of all, I guess let's talk about what is a loss.
What is a loss? And there's many different types of losses as well. So you can have rental losses, business losses, capital gains losses, all of these different types of losses.
All right, so essentially a loss means that the income is less than what the expenses are on the other side of it. So that's a very simplistic view, and a very genuine one too.
Yeah, of course.
So before we actually talk about these in more detail, there is a difference between tax losses and cash flow losses as well. So even when you're looking at financial reports, the loss that might be showing in your profit and loss might be different to the tax outcome. So we're really trying to talk in context of tax right now, so not necessarily a financial report or what you might feel like is a loss to you. We're talking about tax.
Yeah, that's exactly right.
Mm-hmm. Okay, and what I want to do is try and break it up between companies, trusts, individuals, partnerships. So just to try and explain how they work in a context of that. And I will clarify that capital losses are different to income losses. So we'll start off with income losses. That means just normal trading, normal stuff. Capital losses is when you sell an asset that is subject to capital gains tax. So that has different treatment as well. This is something that if you have got a loss, you probably need to get some advice on, to be honest, particularly if it's a little bit complicated. So where do you want to start, Jade?
Should we start with individuals? If an individual has a loss, what happens to it? Where does it go?
Okay. So I thought this would be really simple, but it's actually kind of complicated. So let's start off with just a normal loss. We're going to exclude from that business losses at the moment. So when I say business losses, I mean if you're a sole trader or a partner in a partnership. And we are going to exclude rental property losses for the moment as well. So we're just going to talk about income losses because there's slightly different treatments on those ones. And if you have a loss for whatever reason, essentially that carries forward indefinitely as an individual tax return payer. So why would you have a loss? There could be a few reasons for it, and it may have to do, in all honesty, with some of those things of businesses and rental properties. But if you do have a loss, it will carry forward indefinitely. However, it is your responsibility to use it the first available time. So you can't choose to carry forward a loss into a future year when you could use it in an earlier year, if that makes sense.
Exactly right. So it's essentially just that loss stays on your tax return as that negative figure, and it just carries forward to the next year's tax return and keeps rolling forward until it can be used.
Now, what can it be used against though? And that's an interesting question. So losses have to first of all be used against what's called exempt income. And so exempt income is certain things that you're getting. And I just want to clarify, there's three different types. There's exempt income, there's what's called non-assessable, non-exempt income, which is a different thing. And then there's other things that are just not taxable. So exempt income is realistically things like disability pensions, which is probably one of the major ones I can think of, or carers allowances. There are other types of payments that might also be classified as exempt income. So if you had a loss, even though that exempt income is not taxable income, you must use your loss against that before you start to apply it to other assessable income. So just be aware of that. And again, if you're in that situation, you probably need a bit of help from a tax agent with that.
Yes.
What's non-assessable, non-exempt income? Well, that's other types of payments that are actually classified as that. So again, there's a bit of a list in the ATO about what they might be, but probably the one that springs to mind most right this minute is Job Saver that we had last year. That was considered non-assessable, non-exempt income, and some of those COVID grants such as the cash flow boost. Now, they were specifically told that that's it, in which case you don't have to take off the loss against that, it's irrelevant. And then the other thing is non-taxable income, which is such things like prizes, for example. You might win the lottery. That's non-taxable income. That doesn't have to, you don't have to apply losses to that. Or child support is another one that is considered non-taxable income. Yes, it is income that you're getting, but it's not income that's accessible in any way. So you don't have to apply losses against it. So that was just a little bit of a lesson about different types of income.
And where you can put the losses
and
against.
Where you can put the losses against. So there's two other things I just want to clarify with regard to individuals. You cannot put yourself into a loss position through personal superannuation contributions. So if you say you had $10,000 worth of income, taxable income, and then you made a $15,000 personal super contribution for the year, you cannot have a $5,000 loss created from that. You would only be able to take back to that figure. And the other thing that you can't do with that is donations. So if your donations bring your income into a negative, you'll only be able to claim them up to the point where
it puts it to zero.
Where it would have brought it to zero.
Yep.
Right, next question.
All right, and what about partnerships, Jo? What happens if a partnership has a loss? How does that get split out?
Okay, so a partnership is then, if there is a loss, that is distributed to the individual. So that could be what puts you into a loss. So that will be distributed to the individual or whoever the partners are. The partners may not be an individual. The partnership might have a company as a partner, in which case it would go back to that entity and work out how they treat losses. So, but yes, the partnership will distribute losses out, and then we need to then determine if that becomes part of how that's treated in that individual or company or trust tax return.
Perfect.
Should we go on before we go on to that into rentals and non-commercial losses?
We should. Because
these are specifically relevant for individuals. So if you have a rental property and your rental property is running at a loss, that's known as negative gearing. Now, there is nothing to stop you from claiming that loss against your other income. If that does put you into a loss position, then that would carry forward to further years. There's no prevention on that. But so those rental property losses will allow to be offset against other income that you might have.
So they can be offset against, for example, your wage income.
That's correct, yes. There is really no restrictions on that, but I think you just need to be careful if you do have a rental property that you know what the costs are. It's not the repayments on the loan, for example. They would be, is the interest that's deductible, not the repayments. A lot of people get that confused. And depreciation, like there's a whole lot of work around that as well.
Yeah.
But we're not talking about rental properties today. The other thing that I think is important for individuals to know is what's called a non-commercial loss, and that's particularly relevant for sole traders and partners in a partnership. They're fairly similar. There's just a few little quirks between the two of them, but I will talk about them in general. And often losses for individuals or partners come through from a business not making money. And so the tax office like to think about this and say, well, how do we know this is a genuine business? And there is some parameters around that. Like, how do we know? It's a very subjective thing. So rather than trying to make it that this is what we consider a business and this is what we can consider a hobby, like, again, first of all, you do have to have some sort of business element to it. You can't just go, I've just made up something and called it a business. There has to be something to it. But what they do is for you to be able to use the losses from that business against your other income. So, for example, your salary and wage income or some other investment income that you have to pass one of 4 tests, or there's a couple of other things that you can do. So the 4 tests are, and this is where a lot of people often say to me, I just need to turn over $20,000. Yep, the first test is the assessable income test. Yes, you should have turned over $20,000. If you've turned over more than $20,000, the tax office will believe it's a genuine business. So that will usually get you across the line. But if you haven't done that, there are other tests. So the second test is what's called the profits test, which means 3 out of the last 5 years you've made a profit. You may not have turned over $20,000, but you've made a profit. One of those years, maybe the 4th year or the 5th year, you've made a loss, but you can see that the business has typically done profits. That's the profits test. You can then claim that loss against your other income. The third one's called the real property test, and that's if your real property that you're using in that business is more than $500,000. That's typically used in farming situations in all honesty, and it's probably the one we used most here. The property doesn't include dwellings on that are for private use. So if you have a farm and you've got a farmhouse and the farmhouse is worth $500,000 and the land is worth $400,000, then you're not going to pass the test, even though that the property is worth $900,000. So just be very clear about that. It's the value of the land that's being used. And then the fourth one is the other assets test, which means that you're using assets in the business that are worth more than $100,000. So this might be you have bought a big excavator or a big truck or something like that. It doesn't include cars, so don't think, oh, well, I'll just go and buy a BMW and I'm suddenly over the $100,000. It's actually assets that are used to produce the income in the business. So they're the four tests. There's also what's known as accepted activities. Now, these aren't relevant for partnerships. These are only relevant for sole traders. So those four tests apply whether you're in a partnership or if you're as a sole trader. But yeah, this next accepted activity thing is only for sole traders. And what this is specifically for is for people who are in primary production or a professional artist. And in either of those two, you can take a loss provided you do have a genuine business if your other income is less than $40,000. So that excludes capital gains. So if you happen to have a big year where you've just made a capital gain for some reason, that's excluded. But if you've got a job and you're working and you're earning $30,000 on your part-time job and you're an artist or a farmer and you have a loss and you've not met any of those other tests, you can use that as an accepted reason to take your loss off against other income.
Perfect.
Right. You also do have the ability to ask Commissioner for discretion if you don't pass any of those tests. So in that circumstance, you have to really give them a reason why you're not able to pass any of those tests, but why you would still see this as being a genuine business. Often we use that for farming that is relating to some sort of cropping. So because it's going to take a few years. So vineyards is probably a great example of that. You go and plant your grapevines, you're not going to have fruit and you're not going to be making wine in year one. It's going to take a period of time to get to that, but it doesn't mean you're not in business.
No, that's right.
And then just to clarify with that, there's also a rule that if your income from other sources is more than $250,000, and that includes reportable super contributions, fringe benefits, rental property losses, all of those things, if that takes you over the $250,000 mark, you can't use those non-commercial loss rules. So it's quite complicated.
Yes, losses aren't easy.
So here we thought we were talking about something really easy, and we've just finished individuals. So what's next?
Should we move on to trusts? What happens if a trust has a loss?
Yeah, sure. So a trust can't distribute a loss. It must retain the loss to be used at a future point in time. So if you have a trust that's got a loss, you can't do it. This is where I often find people get a little confused, particularly if they've decided to buy a rental property in a trust. You know, often people come to me and say, I'm going to buy a rental property, I want to put it into a family trust. That's fine, you can do that. But just be aware that you can't distribute that loss to the individuals. It basically sits there until you make a profit.
Right, okay, so it just has to sit there in that trust.
Yeah, but you just have to be mindful that you can only use that if the ownership and control of the trust hasn't changed significantly. And this is the same for companies. So we'll talk about that in a second when we talk about companies. But you can't sort of just distribute or maybe sell your trust to someone else, which is pretty hard to do anyway. But you've just got to be careful that the character of what caused the loss in the first instance and the people who were involved in that hasn't changed substantially. Otherwise, you can't use that loss in the future. It will continue to roll forward while ever that trust is still in existence.
And can you choose when to apply that loss, or do you have to apply it at the first available chance if there's an income?
You would have to apply it at the first available chance. And again, if there was any exempt income, that rule would apply first as well.
Yep.
Mm-hmm. Okay,
companies. The last one.
Companies, very similar to trusts. Companies they don't distribute losses. The loss will carry forward and we're used against future income. And again, there's the control. There's some control tests involved in that. So the first one, the control and ownership test, is that if there's been a change of at least or more than 50%, then they have to have a look to see if another test can be passed. Otherwise, that loss is lost. So you can't have, because companies are much easier to sell than trusts, particularly if it's a discretionary trust. You can't really sell a discretionary trust, but a company could be sold. So if I had a loss company, I could say, hey, here's a business that could really use those losses. I might sell that company to them and actually get some money for my losses so they can use it in the future. So there's some parameters around what they can and can't do there. So obviously if I was to sell my company, then the control has changed by more than 50%. So we fail on that test. So then we have to look at the next lot of tests. And the first one is what's called the same business test, which means that the business that happened when the losses occurred or right before the losses occurred is the same as the business that is now running and is able to then continue to claim those losses. And then there's a new test that came in on the 1st of July 2015, and that is called a similar business test. So I think they're acknowledging that some businesses might not be exactly the same, but they might be similar. There's obviously some subjective stuff around that. I'm not going to try and go into that at all, but just being aware that you can't just sell a loss company and use it for some other purpose.
And so can companies pick and choose when they want to claim that loss, or do they have to use it at the first available chance that they have income to?
I would imagine that they'd have to use it at the first available chance because otherwise those losses, I don't think they've got that option.
Yeah. So you can't pick and choose when to use a loss.
Essentially the idea is if you've got a loss, you use it when you can.
Yeah.
Yeah, because otherwise you start to play losses off against it. Yeah, I think it's just I don't know that there's any. There may be some circumstances you can do that, but I think in general most people would use it as soon as they can. Yeah. And again, they'd have to use their exempt income as the first instance.
Yeah,
to claim that. Let's just quickly talk about capital losses before we finish and how they work, because they are quite different. So if you have a capital loss, so let's say, and it doesn't really matter what the structure is, the rulings are sort of the same, but capital losses can't be offset against income gains. They can only be set off against a capital gain, and that capital gain must be either in that year or in future years. So they do also carry forward indefinitely, and I'm guessing if you've got a company or a trust, there's obviously ownership changes with that as well. But often we see someone will come in and go, I sold some shares and I've made a loss, and they expect to be able to take that off against their salary and wage income. You just can't do that.
No, so that needs to stay there for if they sell shares and maybe make a gain one year, that loss can be offset against that gain.
Yeah, that's right. Now, I just want to clarify with capital losses and capital gains, there is an order to applying this. So let's just have an example. Let's say we sold some shares and we made a loss of $10,000. And then next year, or even in this year, but not last year because we can't do anything about that, we sell a property and we make a profit of $100,000. What we need to do is, first of all, apply that loss. So our $100,000 profit, we apply the $10,000 loss. That comes down to $90,000, and depending on the circumstances, we would probably be likely to get a 50% discount on that. So our $90,000 would come down to $45,000, and that's what would be taxed. Very elementary. What a lot of people think they can do is go, right, we'll take our $100,000, we'll do our discount first and bring that down to 50, and then take off our loss of 10,000, which brings us down to 40,000, which is obviously a better result, but it's not the right way to do it.
No.
So you have to take the losses first before you apply the discount. So just be very aware of that.
Yep, definitely.
All right, is there anything else you can think of?
No, I think that's all we have time for.
Right, I would strongly advise if you have some losses and you're not sure, definitely speak to a tax agent. It can be quite confusing. There's a lot of stuff around it. It is kind of, complicated bits of law. But, but they are available to be used at some point in time. So they aren't necessarily disappearing forever and ever.
Yeah, that's right. Although it's a loss, it doesn't just disappear.
Yeah. All right. Well, thanks.
Thanks, Jo. It's good to be back.